In this video, we're going to discuss ETFs, what they are, which ones we currently invest in, which ones we have and may invest in again in the future. My name's Nate. I'm a popular investor on eToro. If you're looking to get started investing, eToro is a great platform. Comment below. More than happy to chat, more than happy to talk with you through that process of getting set up on eToro. I've been investing there and other places for 10 years plus, just over 10 years. And so been in the markets for 10 years and yeah, it's been good. As I always say, this is not financial advice. I don't know your specific situation, your specific circumstances. This is just my thoughts and what I recommend. But let's dig in. Firstly, what are ETFs? ETF stands for Exchange Traded Fund. We're not going to spend a lot of time around this, but essentially think of a shopping cart or a basket or something like that, where a lot of companies, a lot of stocks are in there, and you can buy companies that are specific to one sector, buy them all just through one asset. So all your money that's put in there is split through those companies. Now, some ETFs are weighted, some are not. What that means is the ones that are weighted will have a higher percentage of your money that you put in go into the bigger companies. So let's take the S&P 500, for example. That index or that ETF, if you go ETF route, that's weighted. So you'll have more go towards companies like Apple and Tesla, Microsoft, Google, those companies versus the smaller companies that are in there. Let's dig into the ETFs that we have. Now, we have these three over here. This is why I've separated them, and we've held these four in the past and may again in the future. And these are these have specific reasons as to why we would hold them or move some funds into these. These three are what we are currently holding as of the end of November 2024. And so these are what we're currently holding, and we're going into to the end of this year with. Now, these letters represent things. They're what's called a ticker symbol. The ETF, the title of the ETF will tell you what's inside the basket, what kind of companies, not exactly what is in each company, but what's inside the basket, what kind of companies are in there. So VTI is the Vanguard Total Index, the Vanguard Total Stock Market of the US, right? The entire US market, it is weighted, meaning more of the funds are going to those companies like Apple, Tesla, Microsoft, Google, some of those bigger companies. But it generally outperforms the S&P 500 just by a little bit each year because it's got the entire US market in it. So close to 4,000 companies are in there. So it's our stability factor. It's our stabilizing factor in our investments. VUG is a bit more aggressive approach. So that's Vanguard's growth or aggressive growth ETF. So you're looking at about 300 companies, and they're your growth companies that generally outperform the GDP, gross domestic product. So generally outperform the general growth, but it's a bit more volatile. So you're going to see bigger swings. You'll see more 1% losses and 1% gains in a day, and you just ride that because it, over history, performs very well, and so we have funds in there. And then VOO is Vanguard's S&P 500 ETF. Now, we use this very specifically. If we use this for our kids' college, right? So we put aside a portion every fortnight out of each paycheck into here for our kids' college, and we use that to keep it separated from these. So that we know specifically what's there. When we have another child, we'll do another S&P 500 ETF, SPY, which is SPY, which is BlackRock's, and so that's what we'll be looking at doing there. if you're not doing something like that, I would just stick with VTI. Okay, because it performs so closely to what the S&P 500 does. There's no need to, just for the sake of it, have these split into different ETFs. There's no need for that. So this is what we're currently holding. Okay, this is what is in our portfolio currently, and these ETFs are what we've held in the past, and we will look to add back into our portfolio in the future, and we will hold these again at some stage. IJR. So I've separated these into two groups, and there's a reason for that. IJR is BlackRock's small cap, so the small businesses. You're looking at about 600 there, and much like VUG, it's volatile, but for different reasons. It's volatile because these businesses are the ones that could go to zero, all right? They could go to zero, or they could skyrocket. So it's volatile for different reasons than what VUG is volatile for. And so you're going to see more swings again, those 1% down, 1% up. You're going to see more swings than you would in like VTI or VOO, the S&P 500. In IJR. VEU is Vanguard's ex-US international ETF. So it's ex the US, so it's everything outside of the US. And this is good if you're just wanting to have some international exposure. Okay, so if you're just wanting to have international exposure to all the stocks, public traded companies outside of the US, that's a good one to do. Now, if you want to go to specific markets, I wouldn't do this one. Okay, if you want to go to specific markets, and I say I will hold these again, this is one I may not hold. I may go to more specific markets like the ASX or the GER40, things like that. The ASX is Australia, GER40 is the top 40 in Germany. So I may go a bit more specific, or I may go EM, emerging markets ETF, just to avoid some specific areas around the global economy. And so that's what these two are: small cap, the small businesses, and outside of the US international. These two are dividend producing. That's a dividend focus, but they still give a bit of capital gain. There's one dividend ETF, QYLD, that I don't necessarily recommend. It's a high dividend yield that gives you money each month. It's a high dividend yield, but it tends to drop. SCHD is Charles Schwab's high dividend. You're looking at about 60 to 90 companies in there, and they perform pretty well. They're slow moving companies, but they pay a good dividend. You generally don't do as well in your capital returns as like the S&P 500. That's your return on investment for the year, but you will see a dividend pay, a stronger dividend payout. SPHD, you'll see the HD. That means high dividend. SPHD, think S&P 500, high dividend. So it's 50 companies that have the best, 50 companies from the S&P 500 that have the best dividend payout for the year and the lowest volatility. So lowest volatility, best dividend payout. They do the formula on those two and they bring in 50 companies. This ETF is good if you're thinking, yeah, the market's going to go into a bit of a rough patch. You really want to slow things down and slow the movement of your portfolio down, the volatility of your portfolio. So this can really add a strong stabilizing factor if you're thinking rough patch, rough seas ahead. Okay. The risk with that, if you're thinking rough seas ahead, is it may be rough seas, but it may be rough seas upward. You're going to miss out on some of the capital growth that your portfolio could see. Good dividend, decent, stronger than these, but you're going to miss out on on the capital growth. So that's what these ETFs are. I would recommend all of them. They're all decent. They're all good. I've invested in all of them and probably will invest in all of them again at some stage. Yeah, but they're the ETFs that I recommend. Thanks for watching. Thanks for following along. To everyone who's subscribed, thank you. If you haven't subscribed yet, be sure to subscribe. My name's Nate. If you want to get started investing on eToro, pop a comment below.